Why is Moody's recent change in the U.S. credit outlook to negative making waves in the financial world? Let's delve into the key points discussed by MoneyVest regarding the potential consequences and the intricate dynamics at play. The recent announcement by Moody's involves a shift in the U.S. credit outlook to negative, highlighting concerns about the nation's fiscal trajectory amid congressional dysfunction. Despite keeping the credit rating intact at the highest AAA level, Moody's points to a deteriorating fiscal position and political polarization as long-term threats to the American economy. This move falls short of a downgrade, but it raises questions about the sustainability of the current fiscal policies. The U.S. is grappling with a significant fiscal deficit, and congressional dysfunction is hindering the formulation of effective fiscal policies. The lack of a clear plan to increase revenues, coupled with escalating deficits, paints a challenging picture. The recent IRS's new tax brackets did little to address the revenue concerns, and the deficits are only projected to increase further, reaching over $33 trillion. This mounting debt is being financed at higher interest rates, creating a potential debt crisis. The situation becomes more precarious as the U.S. borrows at increasingly high rates, both on the long and short ends of the curve. The demand for U.S.-denominated debt and the U.S. dollar is crucial for stability. If this demand weakens, it could trigger a cascading effect, forcing the Federal Reserve into a challenging position. While the U.S. can print its currency, a decline in demand for U.S. debt could lead to a self-perpetuating debt crisis. The recent uptick in 30-year U.S. Treasury yields, reaching 4.8%, is a reflection of the increased cost of borrowing for the U.S. government. This shift is due to weaker demand for U.S. Treasuries and record-high net short positions taken by hedge funds, signaling a lack of confidence in the bond market. The imbalance between supply and demand is creating volatility in bond yields, with fluctuating expectations around Federal Reserve actions and potential rate cuts. Despite a recent pullback in the Treasury market, the overall trend has been a surge in net short positions by hedge funds, reaching levels not seen since 2006. This extreme positioning has created a volatile bond market, with yields swinging higher and lower. The forces of fiscal deficits and hedge fund activities are currently in contention, resulting in uncertainty about the ultimate direction of yields. The ongoing battle between these two forces is creating market volatility, with yields oscillating weekly. The prevailing belief is that yields might have peaked, but the fiscal deficit and debt levels suggest a potential for retracement. The key factor influencing the bond trade is the anticipation of economic weakness. If signs of a recession emerge, coupled with a weakening labor market, the expectation of rate cuts could drive yields lower. Now shifting focus to the equity market, with 30-year yields hovering around 4.5% to 5%, the average PE multiple over recent decades has been around 17.5 to 18. While slightly higher, it is deemed within an appropriate range. The S&P 500's fair value, as per MoneyVest's analysis, sits at 4,000 points, with the current level crossing over 4,400. The technical analysis suggests a bullish outlook for the equity market. Despite the bond market's turbulence, the equity market seems to be responding positively, with the S&P 500 breaking out over 4,400. This divergence between the bond and equity markets adds another layer of complexity to the overall financial landscape. The market is currently balancing between potential economic headwinds and the optimism of rate cuts, leading to intricate price movements. As we wrap up, the situation remains fluid, and the ultimate direction of yields and market trends will depend on a multitude of factors. Everyday Americans, what are your thoughts on these developments? How do you perceive the impact of fiscal policies and bond market dynamics on the broader economy? Disclaimer: the information provided here is for educational purposes only and should not be considered financial advice. Please conduct your research or consult with a financial advisor before making investment decisions.
Before you go, help us by smashing that YouTube like button. And subscribe to this channel, so you won't miss any of our videos. This shows YouTube algorithm that you value our information, and it helps us spread the message. Sharing is caring.